All right, so let's begin the show. Mutual funds growing interest in new age companies or startups like Zomato, Paytm, Mama Earth have started raising concerns among unit holders. Now, these calls being taken by fund managers is now also a case of worry among retail investors. Even if these are very small amounts in terms of calls that are taken, the question is it necessary at all for fund houses to be putting retail investors' money here? The risk may not be disappropriate, but how much is it really reaping the return benefit that's expected? Let's decode all of this today. I have with me Nirav Karkera, Head of Research at Fisdom. Nirav, good evening and welcome to the show. Not the first time where mutual funds exposure to IPOs and startups is under radar or under concern. But then looking at the trajectory, it has really not reaped the kind of benefits a retail investor would be expecting. Okay, the high voltage coverage across channels and across communication mediums that we see that these IPOs and these startups get, when it comes to their portfolio, nothing really matters. I want to understand, or let's just start with getting into the basics of it, Nirav. How do mutual funds invest in IPOs? We're talking about new age companies, startups, even the latest IPOs. What has been the mode of investment, tactical position, and the original, authentic, fundamental positions that mutual funds take?
Yeah, hi Kavita. Always a pleasure to be interacting with you. And this is a particularly interesting subject because, as you rightly mentioned, most of these companies have been capturing a lot of headline space in mainstream media as well as social media. So, talking about mutual funds and how do they participate. So, if you notice, most mutual funds have been allocating to new age tech companies, and most of them have been allocating either at the pre-IPO stage, that is at the anchor stage, or post listing, that is it could be on the first listing or during the subsequent days. So when you talk about positioning, whether strategic or tactical, I feel the proof lies in the exposure that mutual funds have been taking. And for many new age tech companies, you'll realize that the initial exposure that they've taken has been marginal, e- irrespective of whether they took that exposure at anchor stage or post listing. So the initial stake has been marginal, and as the script evolves on the bourses, as there is some vintage added to the company after it lists on the public markets, you will notice mutual funds being really active with the exposure that they're having. So there are a few tech companies that have not been able to hold up really well so far, and the prospects are also not looking as bright as they were when they first launched. So mutual funds have been consistently trimming exposure to such companies. At the same time, there are a few companies that are holding immense promise, and they are racing towards profitability and sustained profitability more than just profitability. You will see a clear trajectory where mutual funds are increasing stake. So it gives a fair sense, if the exposure were any indication of the nature of exposure that mutual funds are taking, we would clearly see that the very initial exposure is slightly tactical in nature for most such fund. And when I say tactical, it does not imply it is just for a very shorter time frame. It is to serve a very tactical purpose and play a particular theme. Whereas as you move ahead, there are at an aggregate level, most such bets that turn out to be well start taking more strategic form and shape.
Right, right. But then also, Nirav, it's very important to understand the rationale behind it, because this is not for the first time that we are seeing that mutual funds have not reaped out anything out of these tactical position or the kind of strategies we are talking about adopted by fund managers. We've had instances in the past as well. Okay, specifically talking about new age companies. What exactly is the rationale? Because a fund managers, it all depends on the fund managers and their experience and their expertise to be taking call, and even if it is a very minimum amount of exposure of the AUM that we are talking about, the fund exposure has a name of a non-performer. That will raise question in a retail investor's mindset.
Correct. Correct, absolutely. So, right at the outset, I would admit and concur to the fact that it is, in fact, a fund manager's fiduciary responsibility to ensure that all bets that are taken or all investments that are made on behalf of unit holders must be done only post thorough diligence, and they must put in their best efforts to ensure that all such analytical rigor is deployed. And at the same time, I would also like to highlight the fact that it is slightly fortunate or unfortunate that most such names have gained far more limelight than most other versus what most other companies enjoy, and this leads to a lot of something that's that could be an effect of the spotlight effect, wherein there is unnecessary attention being given to these companies, and in a very different light than what other companies are you are used to while analyzing. So when we talk about why fund managers are taking bets into such companies, I would say that they follow a very similar diligence and analysis process that they have been employing for most other funds. However, the framework and the model may be slightly differing. Okay, it is important to understand that just because an investment proposition does not fit your conventional framework or your traditional perspective does not necessarily mean it is a bad investment. These companies business profiles are very different, these companies financial profiles are very different, and they need to be evaluated very differently. And I feel mutual fund as an industry and most fund managers have been able to do a pretty good job at evaluating the strength and the value proposition that most such new age companies are offering, right? So they need to be viewed with a slightly differentiated lens. And it was the first time the first new age company came in, we were very averse to even looking at such loss making companies coming in. But there is a reason why each of these companies have the value that they enjoy today, and they have the market cap that they enjoy today. So it is important to understand the fund managers are doing a good job at analyzing. At the same time, the flows are very nimbly managed. So it is not as if they invested at the listing and they have gone through the entire downturn. The flows are very well managed, and it is not necessary that fund managers are incurring loss on all such bets. They are also making money. Yeah.
IPO anchor round by mutual funds, there have been as many as 37, 39 schemes. Total 17 domestic mutual funds have been a part of this anchor allocation round for Tata Technologies, almost of 355 crore rupees we are talking about. Let's not focus on the hits and misses now. You very well explained the kind of mindset a fund manager might be having before putting money or while their money is in these kind of setups. But then from an investor's point of view, an investor personally also would be investing maybe in an IPO, and if they have a mutual fund portfolio, if they're also they see some kind of an exposure, isn't this taking double risk in the portfolio? How do you ensure that you have enough exposure in a particular IPO, especially of the kind that have not turned out really well?
I feel that's a very interesting subject, and investors must pay a lot of attention to this. One must understand that a mutual fund is nothing but a collection of its underlying securities. So, whenever you invest in a mutual fund, you must be equally cognizant and aware of the underlying securities and ensure that you are adequately diversified at a portfolio level. Now, it makes no sense buying a stock incrementally that is already being held via a mutual fund portfolio unless you are intentionally trying to build a much more aggressive position into that stock, or if you have incremental conviction. So I feel it all really boils down to the investor being simply more aware of the holdings that they have, and the holdings of the mutual funds that they own, and then view their portfolio holistically. It could be a combination of instruments. It could be either through mutual funds, direct equities, PMSs, AI. It could be through a variety of product structures or instruments directly. But what matters at the end is what is the underlying and how is your portfolio looking at an aggregate level. When you put all the underlyings together, you need to ensure that you are exposed as much as you want to any particular stock at any particular time.
Sure, sure. So, all right. So, we need to really end the discussion. But then, in a nutshell, I want to understand. So, there's nothing for a mutual fund investor to be worried about if the fund manager has taken allocation in these kind of new age companies. How do you ensure that even if that bet has gone wrong, the fund is not into it anymore going ahead?
So the fund managers are very actively managing the exposures. One must understand that now is also a very shorter period. Most of such new age companies have been listed very recently, and whenever we invest in equities, we are supposed to have a much longer term perspective. We talk about being anywhere beyond 5, 7, 10, and probably forever as long as possible as the timing horizon. So that's one. Be cognizant of the perspective. Two, understand that the fund managers are taking an active call. In fact, you as an investor, the call that you need to take is whether you believe in the fund manager, in the fund management philosophy, and the way that the fund has been managed in practice. I feel if you believe in these three and you're really convinced about the value proposition of a particular fund, you need not really worry about a certain exposure to a certain stock, because by virtue of you believing in the fund manager, you'll also have to believe that he or she knows when to enter or when to exit the stock, and he or she will ensure that the best possible value is extracted from that investment for you.
All right. So, key takeaways for mutual fund investors. Thank you so much, Nirav, for being on the show and helping our viewers with this today. Thank you. On that note, let's take a quick break, and post that, let's get your mutual fund portfolio queries answered by Gautam Kalia. And before I slip into a break, I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your queries. See you after this break.